Ladies and gentlemen, welcome back. This is Christopher Aaron. This is the iGold Advisor channel. It is July 5th, 2023. We need to have a gold price forecast. I've been waiting until I have some clarity on the charts, and I want to show you what the new information is presenting here as far as gold and then, of course, silver. So, the thing to be aware of is that it increasingly appears that there is a future top coming for the price of gold. And of course, then the price of silver and the gold and silver miners. So let's look at these signals today, but let's look at some things that you could do to protect yourself as well. Let's not just be victims here of the manipulation and the markets. Let's actually be proactive. So I want to show you one of the exact investments that I am making now and that our premium subscribers are making. I'm going to share it exactly with you in case you would like to join us. That will give you the protection. That's the key, the downside protection in case this is right, but still keeping that upside potential. How is this possible? I've negotiated this, and I want to let you know the name of the investment ahead of time, and then we'll actually look at the signals setting up. It is called COLIBRI Resource Corp. This is a gold and silver exploration company. It's a Canadian company with offices in Canada as well as operations in Mexico. The ticker in Canada is CBI.V, and in the US, it's CRUCF. For full disclosure, they are not paying me anything to mention this investment. That is not my business model. I simply talk about the investments that I am making and that my paid subscribers are making. And every once in a while, I share that with you here in case you would like to follow us. So COLIBRI, this deal that we have set up here, will protect us in case a top is setting up, but it will allow us to actually still participate in the upside. In addition, they're actually going to pay you 10% a year while you wait for either one of these things to happen. Let's look at all this in this video. So legal disclaimer first, and we go. So let's talk about the macro signals first. What we're doing here is looking at the price of gold going back to 2006. And we're looking at the GDX. This is the senior gold miners on the top, also going back to 2006. And so the big picture signal here that is setting up is, notice here how gold has been relatively flat over the last 3 years. Notice one peak, two peaks, three peaks, all roughly lining up. And notice how the GDX has been making lower and lower peaks. So if the companies that their entire profits are based on the price of this thing here, gold, if they're moving lower, yet gold is moving sideways, this is what's called a negative divergence. So we should pay attention to this. Now, the challenging thing is that it does not necessarily mean that gold is going to top yet. In fact, I think gold is going to make one more significant peak within the next 12 to 18 months, which could be a tremendous profit opportunity, which is why I think we want to keep upside potential, but we want to limit our risk. So I'm going to come back to that investment that we are making right now in our premium group in COLIBRI. I'll talk about that in a few moments. So this is the negative divergence here you can see setting up. And notice you can actually see it setting up on an even bigger time scale. Notice gold is above its 2011 peak here. Notice that the senior gold miners well below their 2011 peak. And I see this getting rationalized by everyone. Everyone likes to give all sorts of different reasons that this is because the price of gold is not rising as fast as their input costs, or other excuses I see being given as inflation is running too high, or the exchange rate is too high, or the manipulation, right? All these reasons. But I'm telling you, I've studied this over every period in freely trading history, and this is always warning of a coming gold top. It always is. So ignore this at your own discretion. So what I want to do is just get rid of this so we can see the chart more clearly. Now, the most challenging part is that if we look at gold in isolation, we look at this consolidation for the last 3 years, and you notice this little blip right there, the false breakdown, I still think that the gold chart, when we look at gold in isolation, I think that the gold chart is still bullish. I think it's going to shape up like this. A little bit more back off here, and then I think attempt number 4, 1, 2, 3, 4, is going to be the one where gold actually breaks out. However, we have as the big picture backdrop here what we just talked about a moment ago, which is the underperformance in the gold mining sector. So it's quite possible for gold to make one more peak, perhaps $2,300, perhaps $2,500, perhaps $2,700 per ounce in gold. It's quite possible for that to happen. The gold miners make one more peak themselves, but then these big signal items here come into play, signifying the top that has been setting up here in the background. And this is how I think gold is going to play out here over the rest of the middle part of this decade. So one more significant peak. I think a lot of these gold mining companies could double, triple, quadruple as gold is moving up. And then I think that big picture topic is going to come into play. We talked about that before, this negative divergence. So I want to come back to one way that you can participate if in fact we get this new peak in gold, but then you can also protect yourself on the downside. And it is this company called COLIBRI that has some positive, strong drill intercepts from their first drilling campaign in gold and silver in Sonora, Mexico. So what I'm going to do is switch over to the premium video right now. You can watch it absolutely for free, and you can see how you can benefit still if gold goes higher, but you can protect yourself if gold goes lower. Now, you've seen the recent videos where I'm talking about some of the mixed and negative signals that have been showing up for silver and the gold mining sector. This private placement is a new form of investment that I'm opening up. I have negotiated this deal specifically with COLIBRI Resource Management for availability for our members here in Elite Private Placements. I want to explain to you why this is so unique. This is a private placement that is in a format called convertible debt. Now, most of the time, I would be wary of debt when speaking about a mining company. Because if the company does not have the ability to pay back, then the company can be liquidated. And this has happened a number of times in the recent history, given how volatile gold and silver have been with other companies. However, in this instance, this is a unique situation with COLIBRI where we have as close to an assurance as is possible that this debt is going to be paid back because they have a payment coming due to them just 15 months from now that is already on paper and is already on the books as a receivable. And so that's why this private placement for convertible debt offers the downside protection here as well as the upside potential of a normal private placement. And it is going to pay you 10% income per year while you wait. So this is a very lucrative deal. This is specifically negotiated for all of our members here. And I want to get into this and explain to you exactly how this is going to work. Let's take this first page from our in-house research report, which is available for you to download. And let's just make sure that everyone is on the same page so that we understand what this investment is all about. Here at the top, we have the key financials, obviously symbols. The company is headquartered in Canada. Primary operations are in Mexico, specifically in Sonora, just below Arizona, United States. Market cap of this company is 5.8 million Canadian, which is about 4.5 million USD. The company has 5 different exploration projects ongoing at the same time. So if you do the math, it's less than $1 million that the market is assigning for each exploration project as expressed in US dollars. So basically, this is as close to a shell valuation. The market is basically saying there's no mineralization at any of the properties that we're going to place a value on. And so if there is a discovery that proves a mineable resource, the upside potential from this type of market cap is many, many fold. You'd be talking a company that could go from 5.8 to easily 15, 20, 50 million market cap, 100 million market cap if they prove a successful investment. There's always downside risk, but from 5.8 million Canadian or 4.5 million USD, your downside risk is relatively limited at this valuation. Shares outstanding, fairly decent share structure, still under 100 million shares. Insiders own about 20% of the company. Cash, obviously, is running low. That's why they're doing this financing, so they can continue drilling operations at their projects. Long-term debt is negligible. Obviously, they're not going to have any revenue for this year, so all of this is zero earnings, not applicable because it's an exploration company. Exploration companies inherently have no revenue. There are about 2,000 exploration companies out there in precious metals, base metals, battery metals, oil, natural gas, uranium. None of them have revenue. So the inherent business model for exploration is to raise money periodically to finance operations and to expectantly go out and find new mineralogy in the ground so that the raise of capital adds to the market cap. That is the hope. Of course, some companies are successful, other companies are not successful, but we want to look at what the downside protection here is going to be, which I mentioned just a moment ago, because that is what really makes this private placement unique compared to all of the others that we have done here over the last 3 years. Let's talk about it further. So they have no known reserves or resources. Obviously, it's an exploration company. They have 5 different projects that they are exploring at the same time. Okay, so this is the basic information. But now what I want to do is talk about the financing terms, because what we're talking about here is not just going out and buying shares in this company in the open market. You could do that. I do think that would be a sound long-term investment because this is a company that I know personally. I have met company management in person. I speak to them on the phone on a regular basis. I have every reason to believe that this company is one that is prudent in managing its cash and in only spending money on necessary expenses. You know, there's a lot of companies out there that are basically scams. You have to be very careful because there are companies out there that will raise money and maybe stick one drill into the ground and then you don't hear from them for another year. That is not the case with COLIBRI here. I speak with management almost every week, and they're actively engaged in exploration across all the 5 sites. So let's talk about what makes this convertible debt private placement unique compared to a normal private placement such as we have done over the last several years. So the form of financing is convertible debt. We'll just go line by line to make sure that everyone is on the same page here. Convertible debt. What does this mean? It is a 2-year convertible debt. So 2 years from the closing date, which will be about 3 weeks from now, is the term. The convertible debt, what it means is they are going to pay you 10% interest per year just to make this investment for 2 years. That 10% interest is paid out to you quarterly. So just to use an example, if you're going to invest, let's say $10,000, you're going to be paid $1,000 per year for 2 years. In other words, $250 every quarter will be coming to you in interest while you hold the investment. The key is that in a normal private placement, when you're going for equity, when you're buying shares in a company, you have the downside risk that if that company, let's say, doesn't make a discovery or they run into a problem at one of their mines, well, you could lose 30, 40, 50%. We've seen it happen. This has been a rough time in the mining industry. For convertible debt, they are promising to pay you back the entire amount of your initial investment. So, if you make an investment of $10,000 and you're earning $1,000 per year in interest, they are promising to pay you back the full $10,000 at the end of the 2-year term. That's what is different about this convertible debt structure compared to a normal equity structure. However, you will not be missing out on the upside, because if this company succeeds, you have the option of converting your debt into shares. Do you see the power of this? So if the company succeeds, you can participate in the upside. Let's say the company makes a massive new gold and silver discovery. They have some good, positive initial drill intercepts at the Evelyn project, also at the Diamante project. And both of those are scheduled to be drilled this year with the funds that we are raising here. So let's say they stick one of those drills into the ground and they find a new massive intercept, 100 meters of 2 or 3 grams per ton. And let's say the company goes up 500% based on that. You have the ability to capture that upside because this is convertible debt. You have the ability to convert your debt into shares at your option. You don't have to do it, but you have the option to do it. So let's talk about more specifics. As I said, the interest is paid to you quarterly. And here's key. I negotiated this with the company directly. We have negotiated that you will be paid your interest in US dollar terms. The reason for this is I have a suspicion, more than a suspicion, I actually have strong analysis here, that the US dollar is going to be rising in strength versus most world currencies here throughout the remainder of this decade, including the Canadian dollar. Here, very well, we can see in the freely traded era, post-Bretton Woods, going back to the mid-1970s, we can see that the US dollar has broken upward right here in 2014 from what was a 30-year downtrend. And look at this, breaking upward and then coming back to retest the breakout point, consolidating, new high, right? So now we're in a long-term rising channel. This rising channel has been going on for 15 years now. And this rising channel is valid until proven otherwise. Say what you want about the debt problems in the United States, but what the charts are telling us is that the debt problems in other countries are even worse than they are in the United States. And so I expect the US dollar to still be rising versus most other world currencies, fiat currencies. And because of that, I did not want to risk us getting paid back in, let's say, Canadian dollars that are depreciating against US dollars. So, right here, this convertible debt placement is going to be paid to us as far as the interest and the principal, all in US dollars. We are guaranteed to receive US dollars for this placement. I think that is key. The minimum order per investor is going to be 7 debenture units, 7 debt units. Each one is $1,000 for 7,000 USD, which is roughly equivalent to 9,250 Canadian dollars. The convertible price for the shares. So let's say that example where they put a drill into the ground and find a massive new intercept, and suddenly there's a new gold discovery in one of their belts in Sonora, Mexico. And let's say the company rises by 500%. Right now it's trading at 6 cents. Let's say they make a new discovery and it shoots up to 30 cents per share. you have the ability, you have the option, but not the obligation to convert the entirety of your investment to shares. And so if you choose to do this during the first year after the closing date, the price that you can convert your shares, your debt to shares, is 8 cents Canadian per share. If you choose to wait one more year into the second year of the placement, it goes up by 25% to 10 cents per share. This is because we expect the company to be rising in time. But when you look at what this is giving you as far as optionality, again, downside protection. They are promising to give you your initial money back if worst comes to worst and they don't find any gold. And they're going to pay you interest while you wait, so you're still going to come out ahead. But if they do succeed, you have the ability to capture that upside by converting your debt for shares. In addition, sort of a icing on the cake kind of deal here, they are going to give you 1/2 of a warrant for every share that you own through this placement, which can be converted to additional shares at 12 cents per share. So this is just additional torque. It's a way to reward private placement investors and say, hey, look, if this company does really good and it starts rising by 200 or 300 or more percent, which is common in the junior mining world, if that happens, you're going to get even more upside by the free half warrant that is given to you as well. The warrants have a 2-year term to them, just like the 2-year term for the shares themselves, for converting and for holding the debt. The minimum hold period after you participate in this financing and you receive your convertible debt, let's say the day after the financing, they stick a drill into the ground and the company shoots up by 500%. The minimum hold period before you can convert your debt to shares is 4 months. By the way, you're being paid interest that entire time while you wait for these 4 months to pass. And if you do choose to convert your shares at any point, whether it's 4 months and 1 day after the closing, whether it's 6 months after the closing, or whether it's the full 2 years after the closing, and then you choose to convert your debt to shares, you keep all the interest that you have accumulated during the entire 2 years. So you keep the 10% per year or 20% for the entire 2 years, and then you can convert your shares if you would like to, if the company is succeeding. Once you convert your shares, there is no hold period once that happens. So that's good. Total financing they're looking to raise is $1.25 million in USD, or a little bit over $1.5 million Canadian. The liquidity for this company right now is low. It's trading about $1,600 per day in total volume. So that puts this company at the higher end of the risk and reward spectrum. Remember, this is an exploration company. They do not have known reserves, but that's pretty much what the market is valuing them at here. Less than $5 million USD for 5 different projects. There's very little value that the market is assigning to this company. And it is the highest reward and highest risk category that we cover here. The deadline for registering for elite private placements, if you are not already a member, or if you are and would like to participate in this deal with the promise of being repaid the full amount of your investment at the end of the 2 years, or the ability to convert to shares if the company hits a home run, deadline to get back to me and registered is Wednesday, July 12th. Deadline to get your money into the company by wire transfer is 1 week after the registration deadline. It's going to be Wednesday, July 19th. So these are the terms. Very unique deal here. And I want to explain to you a little bit more about the company fundamentals and why I think this deal is really unique, especially when we're considering the debt structure that a number of companies have taken on. And some of the companies that have attempted to do this over the last several years that have not been successful, I want to show you why I think this deal is different. So here we are, and we're looking at the chart of COLIBRI going back for the last 8 years. I like this chart. Here we have the terms reprinted for you. I like this chart a lot. This is a chart that is a high potential chart. It is just above the strong support going all the way back to 2018. You can see the hit here in 2018 at this region between 2.5 and 4 cents on the Canadian exchange. You can see this hit here in 2019. You can see this hit here in 2020. You can see these several attempts here in 2022. So every time that the market has come into this level here of strong support, it has represented a buying signal. We can see that there was a downtrend here from the most recent peak in 2021. That downtrend has already been broken. Little pop here, but overall the company is moving sideways right now. So, if this is a company that was already up here in the region around 20 or 25 cents, I would absolutely not be doing this deal. This might be a time to, for example, be selling in a profit situation. I can't tell you how many times I see people, where a chart goes like this, it's already gone up 5x or 10x, and everyone wants to pile on in there. And I just say, no, 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 no. We buy in here. We buy when it's low and close to the support level. And even better if we have that downside protection near guarantee. So this is a chart that is basing, and you can see here the conversion prices I've labeled on the chart. So you can see basically how close the current share price is at 6 cents on the Canadian market to the conversion price for year one, which I said is 8 cents. So basically, if this company does anything that rises by more than 35%, you're already going to have more of a profit here from the shares compared to holding the debt. And then you can take a look at the company. You can see the overall direction that gold is at that time. Let's say if it's above the conversion price, you can check the volume and the liquidity. How are things going? And then you can make a decision at that point whether or not you want to indeed convert your debt for the shares to capture even more profit. But remember, you don't have to do it. If you just want to sit on the 10% interest per year, which is about double what banks are paying right now. Most banks are paying 4 to 5% if you're in a high yield savings account or money market account. So this would be twice the interest that a bank is paying. Let's say the company does rise, but you're just, for whatever reason, you just want to earn the 10% and stick with that, and knowing that you're going to be getting your money back at the end of the 2 years, it's totally fine. You can choose to do that as well. Remember, you also receive a free half of a warrant, which is exercisable at this 12-cent level. So what that gives you is the real torque. That's not going to come into play. If the company just is oscillating in this current range, then you're going to be better off just making the 10% per year and getting your repayment back at the end of the 2 years. But if the company does really well and starts accelerating and breaks this resistance, then that half of a warrant is what gets you your real torque. They're basically just giving you half of a share for every share that you already own for free. It's a way of rewarding private placement investors. You do not receive warrants if you just buy these shares in the open market. Of course, you do not receive the 10% interest per year if you buy the shares in the open market. And of course, you do not receive the ability to convert the debt for shares if you buy these shares in the open market. I do think this is a company that is worth considering in the open market because they have a number of good projects that I'm going to discuss here and highlight. So this is a company that I own shares already in the open market, and I would consider it if I did not own shares. but I am pointing out to you the unique terms that we've negotiated here in this convertible debt deal. So let us look at some scenarios now. We've talked about the structure of the deal. Let's talk about where the rubber meets the road, how this could actually play out if you're participating in this. And then we'll talk about what the company is actually doing on the exploration side and why I'm so assured that the company will be able to make the payments at the end of the 2 years. So first, let's look at the scenarios here. Let's imagine that you're making a $10,000 investment. Remember, the minimum is $7,000 USD for this. Let's imagine a $10,000 investment. And we're going to compare what happens if you make this investment in the private placement and what happens if you make this investment in the open market. So first, let's imagine the negative scenario. The negative scenario is where the stock falls from 6 cents back down to the lower end of the support range at 3 cents. So it falls by 50%, right? That feels pretty bad. That feels pretty catastrophic, right? To lose half of your investment. Look at what happens if you participate in this with us, with this convertible debt placement. Your $10,000 investment is earning 10% interest per year, which means at the end of the 2 years, you are left with $12,000. Meaning, even as the stock fell from 6 to 3, minus 50%, you have made a 20% gain. Are you kidding me? This is very unique in the gold and silver mining world, to have upside potential even if the stock falls. Compare that to what happens in the open market. If you had put $10,000 in this stock and it falls by 50%, your $10,000 is now worth $5,000. You're down 50%, okay? So you can see the difference between what happens in this private placement. You're getting downside protection. That is very rare to have that ability to get that downside protection. Let's look at the second scenario. Let's say the stock stays even. There's no change. After 2 years, yeah, it goes up a little, down a little, up a little, down a little, and it's back where it started, 6 cents. In the private placement scenario, you still make that 10% interest per year for a 20% total gain. You're going to receive $12,000 US dollars. 20% gain even though the stock didn't move at all. Compare that to the open market. 10,000 is now worth 10,000, so no change. So basically, it's the opportunity cost of money here. You basically had your money sitting in the stock for 2 years. It did nothing. What else could that money have done? Well, if it was in a bank account, you could have earned, let's say, 4% or 5%. If it was in this convertible debt, you could have earned 20% at the end of the 2 years. Okay. Let's look at the third example. Imagine, now this is the home run. This is the grand slam example, to use the baseball analogy. Imagine that the stock rises from 6 cents to 60 cents. They do an initial drill program. They hit over 100 meters of 2 or 3 grams per ton, and then they do a follow-up drill program, and they get several drill intercepts with some higher grade cores, and they start to delineate a deposit. And they publish a preliminary economic assessment that has the first resource statement. And that resource statement shows between 1 million to 2 million ounces of gold. That would be the home run potential. I have seen this happen before with stocks. I've seen stocks rise 10x just from the sentiment changing. That's how this sector can work. But we've covered the down scenario, the even scenario. Let's imagine the home run scenario here. Stick with me. In the private placement, you still earn that 10% interest every year. So you're making that interest. Your $10,000 is now $12,000. You then, remember, have the option to go back and buy shares at 10 cents per share. So you take 10,000 of this 12,000. You have the option to convert your debt to shares, and you go back and you convert. you exercise that option at 10 cents. That adds $50,000 of additional profit to your investment. Then, remember, they're giving you that half warrant for every share that you own at 12 cents. So you go back and from your profit, you take $5,000, exercise the warrants at 12 cents, which moves to 60, resulting in an additional $20,000 in profit. Remember, that's their way of rewarding private placement investors. And I negotiated these terms with the company directly so that we all have this ability to participate in additional upside. You add it together, you're going to end up with $12,000 from your initial investment plus the interest, plus the $50,000 gain on the shares and the $20,000 gain on the half warrants, results in $82,000 from your initial $10,000, which is a 720% total gain if this company hits the home run. Compare this to the open market, where if you had a move from 6 to 60, that would be 10,000 to 100,000. So you can see that the only scenario here where the open market beats the private placement by a slight amount, let's be honest. If you had a 720% gain for the private placement or a 900% gain for the open market, neither one of these categories here, as far as the home run scenario, are going to be unhappy with that. But the key to remember is that the private placement, no matter if the stock falls, stays even, or rises in the home run scenario, the private placement for convertible debt has given you the gain in each one of the three scenarios, no matter what happens with the company. Whereas in the open market, you have to risk this loss, this 50% loss, if the company falls. You also have this scenario where the opportunity cost of money, you're just sitting on something that doesn't move for 2 years. And of course, then you have the one upside scenario, which is if the stock rises. So to compare the convertible debt private placement, where basically every scenario ends up being positive, and the only thing you're sacrificing here is a small portion of the gain. And so you think about it, you're sacrificing a small portion of the gain. Either one of these would be totally acceptable for a 2-year return. You're sacrificing a small portion of that for the guarantee, or near guarantee as it would be, that you are not going to take a loss. You're not even going to just break even. No matter what happens to the stock here, you should see a net gain from the convertible debt. Extremely different than buying shares in the open market, even though I do think this is a company that investors who have a high tolerance for reward and risk should own some shares in the open market, as I do myself. Okay, so the question that a lot of people are going to ask at this point is, well, how do we know that COLIBRI is going to pay us back at the end of the 2-year term? How can we be assured? And that's a very good question, because I have seen with some mining companies that when they take on debt, they are unable to pay this debt back at the end of the term. And this is something that we should think about. In doing our due diligence, we should make sure that COLIBRI has the ability to pay us back at the end of the 2 years as we accumulate that interest. Here's why I think this is going to be perhaps the only convertible debt deal that I ever do. This may be the only one. Here's the reason why. So I'm going to bring up this slide, which is from the website of Talk Van Resources. It's a separate company. And notice that they have this project, Pilar, listed on their website. Okay, Pilar is undergoing bulk sampling, drilling. It's due for a maiden resource estimate and then permits to actually make a mining decision. This is an advanced stage deposit. It is not early exploration. Notice this is listed on TalkVan. Let's bring up COLIBRI. Look right here. Pilar, also listed on COLIBRI's website. So, what's the deal here? It's called a joint venture. Right now, COLIBRI and TalkVan are nearly equal partners in this Pilar project. TalkVan owns 51%, COLIBRI owns 49%. And the deal is that in September of 2024, TalkVan has the option to buy the last 49% of this project in exchange for $2 million Canadian. Now, I am so sure that TalkVan is going to indeed buy the last 49%, which is why I am considering this deal. Let me explain to you why. As I said, this is an advanced stage project. This is not early exploration. They've done over 20,000 meters of drilling, and it is due for the first resource estimate, which I believe will show between 1 to 2 million ounces of gold in the resource category. After that, they will apply for the mine permit, and then they will make a mining decision. So this project could be mined here within the next 24 months. It's an advanced stage deposit. Now, TalkVan's market cap is $22 million. That is nearly 4 times the market cap of COLIBRI, which is just over $5 million. Of that $22 million for TalkVan, 90% of it is due to Pilar because TalkVan doesn't own any other advanced stage projects. TalkVan only owns one other early exploration project that has not even seen a single drill program yet. So 90% of TalkVan is based on Pilar, and the market cap is roughly $22 million for TalkVan, meaning Pilar alone is being valued at approximately $20 million on TalkVan's balance sheet. TalkVan just raised $6 million several months ago to advance Pilar. So the idea that they're not going to raise the final $2 million after they just raised $6 million to buy the final half of Pilar is absurd. Of course they're going to do it. Their entire market cap depends on that. Everything about TalkVan is geared toward advancing Pilar toward production and making it a producing gold mine. So in the highest of certainty, as most certain as we possibly could be, you never like to use the word 100% when you're talking about certainty in the investment world, because what do they say? The only thing that's 100% certain is death and taxes. Okay. Aside from that, this is the most sure that we could be that TalkVan will be giving the final $2 million to COLIBRI to purchase the final 49% in Pilar. And that comes just over a year from now, September of 2024. So basically, 9 months before the end of the term for the convertible debt, COLIBRI is going to have the money to pay us all back as investors. Essentially, what we are doing here is providing a bridge loan to COLIBRI. This is as close to an assurance as we could possibly ask for, given that TalkVan has already invested $10 million into Pilar over the last 2 years. They are absolutely, with as much certainty as we could possibly ask for, after investing $10 million, they absolutely are going to invest the final $2 million for the remaining part of Pilar, okay? And that is what COLIBRI is going to use to pay us back. So we should be careful about all other debt deals where we don't have that kind of assurance that the company is going to have an ability to pay us back. This is a very unique situation. Okay, so let's look at the fundamentals now for COLIBRI. I mean, we've already talked about the nature of the convertible debt, the terms. We've looked at the company chart, how it's basing. It's been moving sideways. It's very close to that strong support zone. We looked at the hypothetical scenarios, whether the company goes down, stays even, or moves higher, as far as how the private placement will work out versus the open market shares. Let's continue this in the audio and video format and together review the company fundamentals just as far as the major points. We don't want to get lost in the weeds here. Remember, this is an early exploration company with the exception of that Pilar project, which is due to be purchased in entirety by Tokvan Resources. So let's look at the rest of COLIBRI's operations here and go through this together. The forward-looking statements. We're not going to read every single bullet point here. I just want to make sure you're up to date on the full fundamentals. So we talked about the 5 different properties that COLIBRI has in Sonora, Mexico. The Pilar, which is the joint venture, and then we have the flagship project from COLIBRI, which is this Evelyn/Plomo. Plomo is the new acquisition. We'll talk about that in a moment. And then we have the Mesquite project right here, which is 100% owned, again, by COLIBRI. And then we have Jackie and Diamante, which are joint ventures with Silver Spruce Resources. Let's move on. We already talked about the share structure for the company in the previous slides. Let's talk about their flagship project, which is this Evelyn Plomo. Remember, this is 100% owned by COLIBRI, and I'm not going to read every single bullet point. I want to make sure that we discuss this together so that you're aware of the most important points. So Evelyn Plomo, remember, Plomo was just purchased by COLIBRI for $100,000, and they received it from a company that is going through bankruptcy right now. And remember, they had previously offered to buy the project for $1 million. That offer for COLIBRI to buy it for $1 million was rejected by the original owner a year ago, and now they got to purchase Plomo for 1/10 of that price for the exact same project. And Plomo expands the footprint of this Evelyn project by over 842%. It's a massive expansion of the project here. We can see there are 2,500 surface samples that have already been taken, up to 43 grams per ton gold. So that's a high sample there. You have high-grade trench samples as well. These are surface samples, so we should be aware of that. But the company has done drilling as well on Evelyn Plomo. Before we get to that, here we are looking at where this project is located. So here's Tucson, Arizona. Here's the border of Arizona. Here's California, right? We're going into Mexico here. And so this Caborca gold belt, you can see the number of mines. They all line up in this sort of swath here over about 250 miles in the southern part of the U.S. and the northwestern part of Mexico. And you can see these are all demonstrated gold ounces that are already known to exist at these other mines. 3 million ounces here at San Francisco mine, 2 million ounces, 1.1 million, 1.2 million, right? Look at how close these are to Evelyn Plomo. You've got these mines continuing here into Arizona. So here's Evelyn Plomo. We can zoom it in over here. You can see this deposit right here, 25 kilometers away, has a 15 million ounce deposit right here, La Herradura. So this is very positive to see. And so look at the expansion, right? It's the red in here. That is the new site that they just bought for $100,000. Look at how much this expands Evelyn. I mean, Evelyn was kind of small. This is an 8-fold increase in the footprint of this project. This now becomes a massive landholding here in this part of northwestern Mexico. So that expansion was good to see. Let's move on. There's certainly a lot of potential in this region. Here we are looking at the surface samples that COLIBRI has already taken from Plomo, which is in the orange, and Evelyn is in the blue. Once again, notice how huge this property now is compared to the original size with that acquisition. And of course, we want to focus, especially when we're talking the type of mine that this could be. Sonora, Mexico, Arizona, United States, and Nevada, United States are well known for their open pit types of mines, which end up being heap leach operations, where you don't have to dig half a kilometer or a kilometer into the ground and deep and dig these expansive underground tunnels that gets really expensive and requires, $500 million in capex just to bring the project into production. These types of surface samples here are indicative of what can be an open pit project. And so when you're talking open pit, and especially in Mexico, where the labor rates are a lot less than in the United States, and also the conversion rate between the US dollar versus the Mexican peso is quite favorable. Basically, anything above half a gram per ton. Even there are even some mines in this region that mine gold at 0.3 grams per ton. So really anything in the green, orange, and then, especially when we get above 1 gram per ton, and then the high-grade samples above 5 grams per ton, you can see how many of these high-grade and medium-grade samples have been seen all over. Certainly, we are going to be focusing on the main zone of Evelyn for the upcoming drill program, as well as the El Suaro target here. These targets being about 1 kilometer away from one another. And then we have about 1.5 kilometers away, the San Perfecto and the Pavo Real projects here. So, this entire zone here is really looking to be the flagship zone of the main project here for COLIBRI. Let's call this a 3 kilometer by 1 to 1.5 kilometer in width zone, where you're getting the majority of the high grade intercepts. We could perhaps add the Banco de Oro project with the 5 grams per ton samples here. So it's really going to be in the western part of Plomo and the eastern part of Evelyn that we're looking for the majority of the funds that we are now raising to go into a drill program. Here we are looking at some of the magnetics, and with the actual drill results that have been done already at Evelyn Plomo, it's been just over 10,000 meters of drilling. And some of these holes are pretty decent here. We can see 15 meters of 2.36 grams per ton. This is a good hole. We can look at 14 meters here of 2.82. This is a good hole. Some of these holes, 86 meters. So this gets quite wide right now. It's a lower grade, but when you have this amount of width, there's the potential here for sticking another drill into the ground. You start to get a wide area of this kind of grade, and it starts to approach mineable status. What can we look at here? 29 meters of almost half a gram per ton, 34 meters of, just above that 0.25 cutoff. So there's nothing super high grade. I'm not trying to say that they've found a new bonanza deposit, but there's also clearly something in the ground here. This is not greenfields exploration. This is exploration that has already seen some encouraging results. And remember, the market is basically putting a $1 million market cap on this entire project. So it's valuing it as close to nothing as you could. The market is certainly saying that there's no mineralogy at this point that we deem mineable. And so that's our opportunity. If the market already agreed, if the market already was valuing this as an economic deposit, there would be no chance to make a profit in this investment. We have to be looking at something here and saying, look, over a 2 by 1 kilometer stretch here, when we look at all those targets, they have a number of intercepts here that are suggestive of significant gold in the ground. These are drill intercepts. So they have seen the gold in the ground, and it's about now expanding that and trying to find something that gets wider and higher grade. So they're not just throwing darts at a board here. They have the actual results to be following up on now going forward. That's the Evelyn Plomo project. Next steps, as you can see here. And I have been told by management that they are targeting a 6,000 to 7,000 meter follow-up drill program with the money that we are raising for them right now here over the next year. So they're going to have a lot of news coming out in addition to all these different studies that they will be doing. And there it is right there in yellow. So Q3 or Q4 of this year, drilling program on their highest priority targets. I wanted to mention as well that one of the unique things about COLIBRI is that they own their own drill rig. They own one reverse circulation drill that costs several $100,000. So the fact that they can do that drilling in-house dramatically reduces their operating costs going forward. So once they raise money, they can really stretch that money in ways that other companies cannot necessarily do. So that is the Evelyn Plomo project. That'll be the highest priority project for COLIBRI going forward. Then we want to look at some of their secondary deposits here, and especially one of them, the Diamante project, is no slouch. Even though I call them secondary projects, this one is no slouch. So let's look at this. These are a little bit further south, and you can see really these three projects: Diamante 1, Diamante 2, then this El Mesquite project here, and then the Jackie project, are all in this zone. And look at the scale here, 2 kilometers. So within about 10 to 15 kilometers, they look to be consolidating a zone here, quite similar to the Evelyn Plomo zone. And so you can see the grab samples. We're going to focus especially on anything in this light blue color and above, especially moving into the 0.5 gram per ton here in the magenta color and then blue for higher grades. So we certainly see some good-looking higher grade samples in Diamante 2 and in this corner here of Mesquite. So something of a zone here forming in this northwestern section of these properties. Let's talk about it. The Diamante project. This is the 50% joint venture with Silver Spruce Resources. So COLIBRI is a 50% owner of this. They will remain 50% owners. There is no option contract for either one of the companies at this point to buy it out outright. So it's different than the Pilar project. And we can see here some of the historical samples. We looked at that in the last slide. Let's move on to look at some of the actual drill intercepts. They did do a first ever drill program at Diamante just last year in 2022. And so this is why I'm saying, Diamante, even though it's theoretically one of their lower priority projects compared to Evelyn and Plomo, it is no slouch, and this really has potential to it as well. Look at some of the intercepts here from the El Palado target at Diamante. 6 meters right here of 278 grams per ton silver. So this is a bimetallic project. You also have quite strong zinc and lead grades somewhere in here with a lot of these holes. So they would be getting bimetallic credits for their mining of the precious metals. I mean, when you're talking about silver, there are many companies out there that mine silver in the range of 50 to 100 grams per ton. So here you're seeing 278 grams per ton, 871 grams per ton, 410 grams per ton over 6 meters, right? So for silver, this is looking really good. 165 grams per ton. Let's look at some of the higher ones. 453 grams per ton over 4.5 meters. 9 meters here of 312. 13 meters here. So none of these intercepts are super long yet. We're not seeing anything like 50 or 100 meters. But there's something there, right? Remember, this is early exploration. It's not greenfield. They've done one initial drilling program thus far, and the first drilling program is showing mineable grades of mineralogy. They need to do further drilling, continue to expand this, continue to show this kind of mineralogy, and then the market may put a significant re-rating on this stock based on having something approaching a mineable deposit. Let's look at some of the gold grades. Almost 10 grams per ton here across 1.5 meters. So again, this is a high grade gold. It's short though, 1.5 meters. On this 6 meter one, they had 4.6. That's decent to see. What else? Let's look at some of the high grade. 5 grams per ton here across 4.5 meters. 5.5 grams per ton across 4.5 meters. So there is gold and silver in the ground here. I think that's the important thing to take away from the Diamante project. I expect this to be, from the standpoint of the 5 projects that COLIBRI owns and the 4 that it's actively managing, because remember, Pilar is being operated by Tocvan as the 51% owner. So of the 4 projects that COLIBRI is actively managing itself, I expect order of precedence to be Evelyn Plomo as the first and Diamante right here as the second. Here's the zoom in on Diamante 1. We can see the various places where these rock samples have occurred here over the previous years of sampling. Same thing for Diamante 2. Plans going forward. I mentioned a phase 2 plan is in the works. That will be what some of the funds here are used for. Some of the $1.25 million that we are raising right now for the company will go into phase 2, which should include a drill program. Remember, they're not entirely responsible for drilling Diamante. Silver Spruce will provide 50% of the funds for that. So that will be a joint venture project. El Mesquite here then is right next door. Remember, this one is 100% owned by COLIBRI. Remember, this is right next to those Diamante projects. We could see all in this northeastern corner of the project here the various mineable grades of samples that they have found over the last several years. So there's something shaping up here in this corner of the deposit across 362 samples. They had 22 high-grade samples thus far. They have done drilling as well at this Mesquite. Some of these intercepts got halfway decent, but again, remember, we're moving down now in precedence of the range of the projects. But let's just look at a couple of these intercepts here. 3 meters of 0.5 gram per ton gold, 166 gram per ton silver. That's a decent intercept. 4.5 meters of 0.4 gram per ton gold. Let's see, 4.5 meters of 0.5 gram. So there's some low grade, moderate intercepts here on gold. A couple decent intercepts on silver, slightly above 100 grams per ton or approaching grams per ton. Some copper intercepts here as well that they would get byproduct credits for if this was ever to become a mine. They will be conducting additional reconnaissance as well on the Mesquite project. But as I said earlier, I expect the vast majority of the funds that we are using to go toward Evelyn Plomo and then Diamante as the top 2 projects. So last but not least, we will talk about Jackie. This is the second project that is the 50-50 joint venture with Silver Spruce. And we can see the LiDAR studies and the ground exploration that has been done already. You do have some sampling that has been done here already. 9.5 grams per ton gold and 515 grams per ton silver in that sample right there. That's a high-grade sample. 4.1 grams per ton gold. Remember, these are initial samples. Here we can see the zoom in of the Jackie deposit, and note that it is 7.5 kilometers away from the Santana mine over here, which is owned by Minera Alamos. So this is a mine that is going into production. It's already gone into production, expected to be in commercial production, which means it's fully running at capacity this year. And this should be producing 30,000 ounces of gold per year. So it's just to show the proximity here. I mean, remember, we're in this entire zone, this trench of mineralogy in this section of Mexico. And so you have mineable gold all throughout this area. Okay, so there you have it, guys. This has been an expose on the deal that we have just negotiated. Myself, personally, I've negotiated this with the COLIBRI Resource Management. It is the very unique convertible debt deal that gives you the downside protection. This is the key. If the company does not succeed, you are being given your initial capital back plus the 10% per year interest payments that you get to keep. So you have that downside protection. That is the key that makes this different from any other typical investment in a gold and silver mining company. If the company does succeed, of course we hope they succeed, if they do, you get that upside because you have the option to convert your debt to shares at your discretion at any time within the next 2 years. And remember, you get to keep the interest payments that they make to you while you're waiting. So you can wait till the end of the 2 years, collect your 10% interest per year, and at the end of that, make the decision whether or not you want to exchange your debt for shares. Remember, I would be very wary about any other convertible debt deal because I have seen companies that are unable to pay back their creditors. I've seen this happen a number of times over just the last 2 or 3 years. Some much bigger companies, high-profile companies, I won't name any names, but some high-profile silver companies have been unable to meet their payments. And the reason why this one is the only convertible debt that I am considering right now personally is because we have that unique situation with Talkvan, where Talkvan has already invested $10 million into the Pilar deposit. They are ready to make a production decision here within the next 6 months. And all they have to do to finalize that is to do the final $2 million payment. So the idea that they would invest $10 million and then not invest the last $2 million is just absurd. So when Talkvan makes that final $2 million payment to COLIBRI, that is why we have that assurance that at the end of the 2 years, we have the downside protection and we will be able to get our capital back. So the deadline to register for this private placement, you must be a member of the Elite Private Placements program. You can find that at the iGold Advisor website. Once you are a member, the deadline to register, you can download all the forms, is Wednesday, July 12th, 2023. I cannot make any extensions to this, so it is a week from Wednesday coming up. These things move quickly as soon as they are crossing my desk, and then we have to get all the paperwork together and get the funds to the company so they can start their drill programs. If you have any questions at all, make sure to just pick up the phone, call our offices. The number is on our website, or send an email to our support team, support@igoldadvisor.com. We're happy to answer any questions that you have about how this type of deal works. I hope to have you join us. This may be the only gold and silver mining company investment that I would ever consider that has downside protection, pays you income while you are waiting, yet still has the upside potential. Think about it.